Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our class on trend patterns and their interpretations. Now, tonight's class is brought to you by ETX, and for those of you who are joining us through an internet promotion and don't know much about ETX, we are a regulated provider, regulated by the FCA, so therefore I'm required to give you a risk warning. Trading, whether binary options, CFDs, spread betting on the ETX platform may result in the loss of your deposited funds. Please ensure that you fully understand the risk and seek independent advice if necessary. ETX Capital provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided during this webinar is for educational purposes only, and is not intended to be a personal recommendation or construed as advice. All traders must understand that there is a high element of randomness to the markets, and therefore they will experience both winning and losing trades while following a strategy. Different traders following the same strategy will achieve different levels of performance. Past performance is not an indicator of future results. Now, for those of you that don't know much about ETX, we are a fast-growing financial services company based in the City of London. We are authorized and regulated by the FCA, the Financial Conduct Authority, and we're also a member firm of the London Stock Exchange. So, that being said, let's talk about trend patterns and how we might interpret them in our trading. Now, trend patterns fall under an area called technical analysis. Now, technical analysis refers to the study of financial markets based on price movement. It assumes that it uses the assumption that the price of a share or an asset reflects all the information about that share or asset, including market sentiment as well as its perceived value. Charting refers to technical analysis that is performed through careful inspection of price data for indications of well-known patterns that emerge in prices. For example, head and shoulders, channels, triangles, and wedges. Now, these are patterns that appear based on price movement on a chart. Okay. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments. Pattern formations do not form a trading system, but they rather provide an indication of future trend of a price and key psychological barriers that form support and resistance lines. So when these patterns appear in price movement, we can use them to interpret where we think price can be headed. Now, there are many different patterns, and you'll hear about all kinds of weird things like teacups. Okay. Now, there are lots of ones that are off the wall, and there's some analysts or strategists who teach all about their particular method or their particular operation of this odd pattern. But there are also some very standard, well-known, well-developed patterns that everybody uses and understands. And these fall under the category of triangles, channels, wedges, and then the most involved one, which everybody talks about and everybody uses, is called head and shoulders. Now, these patterns develop as prices moving in trends and are put together by support lines and resistance lines built or drawn onto a chart using swing highs and swing lows of price movement. Okay. So a triangle is formed between converging support and resistance lines. A negative sloping resistance line indicates a reducing level of profit taking. I'm just getting my highlighter out here. Okay. A reduced level of profit taking or more uncertainty about the value of a share or a security. Okay. So this is a negative sloping, or this can be a negative sloping, whereas this is a positive sloping angle. So when we see angles sloping this way, what do we also see? We see partial downtrends, but these can form in downtrends or uptrends. Because remember, price doesn't move in a straight direction. Price moves in hems and haws, peaks and valleys, peaks and valleys. So this can form in a valley or a peak of an uptrend. Okay. So you have to be concerned with a triangle of the direction of the support and the resistance lines. So that would be when you see the triangle form, this slope or this slope, or it forms that slope. So it's very easy. An ascending triangle means that the support line is ascending or moving upward and the resistance line is moving parallel. In a symmetrical triangle, both the resistance line and the support line are converging on one another. And these support and resistance lines are developed by drawing a line between swing highs and swing lows. When you can connect 3 low points, now they're similar to trend lines, but they're not trend lines. In this case, you can see that we have the parallel because we have a swing low here, a swing low here, and what we're looking for is price getting congested in, and I know there's a name for it. I'm not very good with math, or I was very good at math. I'm not very good with memory and back in the old geometry days. But there's a name for when the triangle comes together in this peak. There's also a name for this distance and this angle, and there's also, I don't know if it's hypotenuse, I don't remember, what the difference is between this angle and that angle. But we don't need to call them by names. All we have to know is when the price moves towards the center of the triangle, it's telling us the price is getting congested. Okay. The buyers and sellers are they're uncertain and they're waiting for something to cause a breakout. So we're getting pent up demand. We're getting, the buyers are getting cooped in. They're getting stuck in this triangle and they want to break out. So once the support or resistance line is broken, pressure that is built up as a result of the uncertainty is released. And a certain amount of momentum is added to the price change in the direction of the breakout. Now the price can break. There isn't a rule. There is no guarantee that when this forms, price is going to break this way or this way. Okay. All we're saying is when it gets stuck in here, we're getting pent up demand and it will break either this way or this way. So it can break up or break down. But there are formulas that can be applied to understand the pent up momentum and which way, how far that momentum will carry the price. There's also a way that we can use volume to distinguish how big of a pent-up demand it is, and volume might also help us determine which way it's going to break, because if we have an ascending triangle and price has been moving up steadily and has now moved in here to the center of a triangle, if we see an increase in volume, most likely what we're going to do is a breakout and it's going to continue the current trend that it's on. So the interpretation of these triangles is critical, but first we have to be able to recognize the triangles. So there are specific variations of triangles that can occur, namely ascending and descending triangles. An ascending triangle has a horizontal resistance line, and a descending triangle has a horizontal support line. So again, they're relatively easy. Here we have a horizontal support line, and we have a resistance line. So remember, support and resistance are reversed when price is moving up or price is moving down. But in this price, the price is falling downward. So our trend line is the resistance because price is moving down. In our uptrend, it is support line because it's supporting the price above it. So we can see, and triangles don't form these perfectly geometrically laid out things, but we can see this narrowing of price movement, and we can see it moving into a point. Again here, again here, again here. And then we're waiting for the breakout. Okay. And this is what's important, is seeing that pattern. So I have some charts prepared. Let's go over and look at a couple charts so you can actually see. Okay. Now here is the beginnings of a formation of a beautiful triangle that had occurred in this price. Okay. And we did get a breakout. But it actually occurred earlier than expected because we did not get in as much. But we can see how the triangle had been converging together. But then we did get a breakout of that, and we got the sellers moving into the marketplace. Let me turn off, let me get rid of my markings here. Sorry about that. Again, here now, here we have a beautiful formation of a triangle. So we can see the resistance line being drawn with the swing highs here and coming down. Here we have our support line. I'm sorry, here we have our resistance line. We have our support line here because we're moving in downtrend. So our resistance line is what the price has to break to come through it. We have our support line here, and we have the beautiful formation of a triangle. So what we're expecting is some type of a bullish breakout, and when we get a confirmation and we get the breakout, we could trade it in a particular direction. But right now, we don't know where it's going to break. It can break down and continue the downtrend, or it can break out and break upward and move into an uptrend. We'd have to use other indicators and other means to determine this. And in this case, we also got a bullish confirmation with Japanese candlesticks. But we're still waiting for it to make a move out of the triangle. Now here we have what's called a wedge. Okay. And we're going to talk about wedges in a second. But a wedge is a triangle. It's not a triangle because it's not moving into a pent-up demand. It's moving in, prices are trading in a particular channel. Okay. And we can then interpret that channel. But it's different. We have triangles are the most popular and the most reliable. But then we have channels and we have wedges and we have rectangles. Okay. They're harder to interpret, but they are patterns that we see on charts, and when you study them, you can come up with some idea of what you might expect them to do. So let's go back to my PowerPoint and let's talk a little bit more about the different shapes and patterns we can get on a chart. So hold on, let me pop my... So we have the triangles, ascending, descending, and symmetrical. Now, with the triangle, it's important to note that an ascending triangle can also be found in a downtrend. That's what I mentioned to you first. Because we are forming, you have peaks and valleys, and an ascending triangle in a downtrend can be found in one of those peaks that are going on. Now, there's an assumption that when price breaks out of the pent-up demand in the center point of a triangle, that it will have a particular amount of momentum. And this particular amount of momentum can be calculated because it is assumed that it will have at least some momentum of the distance between the price of the beginning of the triangle, between the original support and the original resistance line. So the distance between the rising trend line and the resistance line will give us our projection. So if a resistance level had a value of 1 and the start of our trend line had a value of 0.5, then our projected value would be 1.5 upward. So we can then start applying some figures. But before we can actually project any of this, we should be combining it with volume. Okay. When in an ascending triangle, volume usually contracts. Although there are a few number of cases that show volume has not contracted, if you're going to use it for a trading decision or a signal to make a trade, we would want to see volume supporting our decision. Volume is, again, the amount of trades or contracts taking place in the marketplace. When we're going into the pent-up demand here, we would expect volume to contract because people are leaving the marketplace. They're not leaving the marketplace. They're just not sure what to do, so they're not buying or selling. If we see a shift or something out of whack in volume, we might not value the signal that we're getting. So we want to be careful because we would like to see volume contract because that's telling you the buyers and the sellers are sitting on the sideline waiting for something to happen. If it contracts, okay, then you're on the right keel because when it starts to increase, volume should jump when there is a breakout. And that will give you a confirmed breakout that you know is, and that's what establishes that momentum. So we also have channels and rectangles. Channels, rectangles, and wedges. Personally, on my personal, I don't use any of these. Okay, I use triangles, but I do not use rectangles, wedges, or, because to me, this is basically a rectangle is nothing more than a double bottom or a double top. And I don't trade without triple tops and triple bottoms. Okay, a channel, it's just, I mean, channels form all the time. And it's just very hard to make any sense out of them. They're just lines you're putting on a chart. Now, lots of people swear by them, but they're simply a level of support and resistance that are helping you project the trend line. And when something happens and it breaks out of the channel, it's telling you something weird's happened with that trend. But we have up channels and down channels. We have rectangles. Rectangles, to me, are nothing more than basic support and demand. I mean, support and resistance lines. So I don't pay that much attention. You know, you can get yourself all involved in lots and lots and lots of different types of interpretations, different types of systems, different types of patterns. Now, these are very popular patterns. Don't misunderstand me. I just can't make any heads or tails personally to see the value in them in my trading or my decision making. Again, triangles I do, and head and shoulders I do. Wedges, to me, are just a simple variation of a triangle. So if we were looking at this first chart that I showed you, the live charts, let's go back there. Okay, this is a beautiful triangle. We could say this was a wedge. Okay, it was an incomplete triangle. It was forming a beautiful triangle, but it broke out before, so we could have said it's a wedge. So, to me, a triangle and a wedge are virtually the same thing. Now, wedges are similar to triangles, and these patterns are formed between converging support and resistance lines. However, where the support and resistance line in a triangle have one positive, one negative slope, the support and resistance lines of a wedge would both have either a positive or a negative slope. Wedges with positive slopes are called rising wedges, and one with negative slopes are called falling wedges, or an ascending triangle and a descending triangle. Okay. Now, what do you determine if it's what we're looking at, whether it's a triangle or a wedge? Well, I just call it an incomplete triangle. We had a breakout before the triangle, the demand got into the center of that triangle. Now we come to one of my favorites, and that's called head and shoulders. I'm sure you all read about them, you heard about them. Some of you are already trading with them. But head and shoulders, is just because of the name, sticks in people's minds. But it's also a very, very reliable pattern when it fully develops. And a head and shoulders is exactly what it says it is. Okay, it's a combination of several different price moves that forms a neckline or what could be a support line. And what happens, price moves up, peaks, and it comes back down. And it comes back down to that support line, or it becomes what's called a neckline. Price then bounces off of it and moves up to a higher peak than it had before, and then comes back down to that neckline or that resistance line. Now, at this point, you wouldn't even know that a head and shoulders pattern was forming. When the price peaks back up and it hits this point, now we have the beginnings of a head and shoulders pattern. Even though it began all the way over here to the left, until we have the right shoulder, we have nothing. Because otherwise, you just get lots of these all the time. Now, there are all different types of traders use different types of interpretations of how high or what the distance has to be between the formation of the shoulder and the height of the head. Okay, I just say it has to be higher. Okay, because you have people with flat heads, people with high shoulders, people with arched shoulders, people, okay, so if you just look at it that way, but it must be higher. Okay. I'm more depending on the neckline or the resistance line. Now, some people can be arched a little to the left, or you can be angled. So if the neckline is right down here, a wee bit lower, because it's not an exact science. So yes, you could have, it's beautiful here, but you could have the head, the left shoulder form the neckline here, come back up, form the head, but it could have formed, say, here, come back down, and came a little bit slower, and then form the right shoulder. Okay, well, so you have a person who's got a limp, you have a person that's tilted to the right, you have a hunchback, but it's still a head and shoulders pattern. In reality, you don't get things as pretty as you do on a little sketch chart, but you still have the formation of the left shoulder, the head, the formation of the right shoulder, and the shoulders have to be fairly equidistant, and the neckline must have formed, and then the middle peak must be higher than the shoulders. Okay. So a head and shoulders pattern describes a price movement that depicts a head and shoulders of a person. Head and shoulders is a reversal pattern from a bullish trend to a bearish trend. Now, there is also the inverse head and shoulders pattern, which is exactly the opposite. Okay, so if it forms, one forms in an uptrend, one forms in a downtrend. The pattern starts when the price graph crosses the support line upward. So in other words, price is moving up and breaks through a new support line. Okay, and forms the left shoulder, and it's completed once the graph crosses the support line downward after the formation of the right shoulder. So when we get the right shoulder confirmed, it's giving us a price for it, because price, I'm sorry, I don't know what I just, hold on a second. There we go. Okay. So price had been moving up Come on. Okay, price had been moving up, and then it broke above its resistance line, which became support, fell back down to support line, bounced off it and moved back up, came back down. What's happened is once it forms the right shoulder and breaks below that neckline, it's telling you the markets have reversed. So prices move from an uptrend to a downtrend. And when this is fully developed, you can't see it until it's fully developed, but when it fully develops, it gives you a very good signal that the trend is over and price is reversing itself. Now, the popular head and shoulders pattern is essentially a triple top, except that instead of all the peaks hitting the same resistance level, the head peaks slightly higher than the shoulders. Some investors have specific beliefs about the amount of a bearish fallback that should occur between the tops. with some allowing 10% loss, some 15% loss, but you have to kind of figure out what you want to do. Signal strength is bolstered by an agreement from other indicators, such as waning volume as the trend nears its exhaustion. So, like I said, in reality, it's harder to see. It's easy to see on my little chart over there, but here you have price breaks above its support line, its resistance line in an uptrend, becomes support, moves up to a resistance line, bounces off, comes back down to the support line, bounces back through, breaks the resistance line, comes up higher, comes back down to the support line, goes back up to the resistance line, and then breaks out. So we have our left shoulder, our right shoulder, our head, and then it breaks down and it's signaling that this trend that it brought us here to begin with is over. It's a reversal. It's a market reversal. So when we see a head and shoulders pattern developing, we want to watch it to fully develop, and then we can use it to make important trading decisions. Now, there is actually a formula. There's formulas for all of these patterns, and that's what makes them nice. They're not very complicated. What we want to do is we want to be able to set a target price, because when we enter the market at the sell signal, especially in the head and shoulders, that means it's broken below the neckline after it's formed the right shoulder. We want to be able to figure out how far the market should move. So the formula is pretty simple. It's T, which is our target price, equals the neckline minus the head minus the neckline. Where T is the target level, N is the neckline, H is the pattern's head level. Okay, and what that will give you is your target level, where you could then set your target here. A lot of traders would set their stop loss at either the top of the head or the top of the highest shoulder. So you can get all three of the important pieces of information you need, but you need to have a target level and a stop loss level and an entry point level in order to calculate your risk tolerance. Now, somebody just asked, can we use patterns in any time frame? The pattern you're looking to develop has to develop on the chart you are using. You don't adjust charts to find a trade. If you're trading short-term trades and you're looking at a 15-minute chart, you want this pattern to appear in your 15 minutes. You're not going to go back and find it in a one-day chart and say, I can use that to trade my 15 minutes. Doesn't work that way. Okay. When you're doing anything, whether you're looking at support and resistance, whether you're looking at trend lines, you're only looking in whatever chart you have developed for your trading system. So you don't go back and say, I'll look at this in a one-day chart, and when I see the head and shoulders or I see this, I'm going to go trade that asset in a short-term trade on a 15-minute chart. Anytime you're looking at patterns, you're looking at support and resistance, anything you're looking at, you're building on the chart in a time frame in which you've developed that the chart fits your trading rules and your trading strategies. Okay. So if you see this pattern develop on your half-hour chart, and because that's what you're using to trade, that's what you'll use to trade from. Now, also we have the inverse head and shoulders. It's the exact opposite. Just flipped over and it develops in a downtrend as opposed to an uptrend. Then we also have chart patterns which are multiple tops and multiple bottoms. Okay, and these occur in ongoing uptrends, multiple tops. Okay, this is when we have price moving up and it hits a resistance line, bounces off there and hits another, comes back up to that resistance line, bounces off of it, and it formed two tops. Okay, what is it telling you? It's having a problem breaking through that resistance line. On the other side, we have double bottoms. I don't trade from either double tops and double bottoms, only because they occur quite often. So they occur so often that they're wrong sometimes more than they're right. You could spend your time searching, finding these, and spend your time trying forever to interpret them and not get anywhere. Because the more important one is the triple top and triple bottom. Now, anytime you're looking at support and resistance, and you see price having a difficult time breaking through a level, you know that that level is crucially significant. The more times it hits that level, I can't break through, okay, the less likely it's going to break through the next time. Now, when it hits it 5 and 6 times, statistically, it's sooner than later going to break through. But a triple top would tell you, if anything, if I was in the market, I would want to be exiting the market. Say, for instance, you bought Apple at 139, and you were hoping to go to say 49. But every time it got to 144, it hit 144 and fell back down a couple points. Later in the day or the next day, it went back to 144, but it couldn't break through there, came back down. Well, the next time it hits 144, you might as well get out of the market and take your profit, because then you're just dealing statistically. Do you think what is going to drive it higher than that price? Or will it just end up falling back down? Because what happens is the buyers haven't been able to gather the momentum needed to push it higher. Same thing in a triple bottom. Now, these are like W's and M's, but they are significant indicators because you've had that price level 3 times tell you something. So a triple top is a price pattern which is formed in an uptrend and is followed by a drop in prices. This pattern comprises 3 consecutive peaks arranged at the same level and 2 bottoms. The highs and the lows of the price are connected by resistance and support lines. The formation is considered to be completed if the price breaks the pattern's minimum. It can be interpreted as a downward direction of the trend serving as a signal to sell. So again, we can use this triple top to also come up with our target prices, because when we see this pattern develop, we see price moving up, touching that resistance line, can't break through, falling back down, coming back to that resistance line, coming back down, coming back down, and moving back up for the 3rd time. Now when it falls down to its original support line, it breaks that support line. When it breaks that support line, it's generating a sell signal. We would then set our target to T is equal to S minus H. T is the target that we would be looking, the momentum to carry it, because see, all of these are momentum trades. There is certain time that you can calculate what you expect the momentum at the time of the break. So in this case, we would take our support line, whatever that price was, minus the height of our resistance line, and that would give us our distance for the target. So T is equal to our target level, S is equal to our support level, and H is the height of the pattern, which is the difference between support and resistance, and we would have T is equal to S minus H. And that would tell us where our target price would be that we could expect it to fall to. Okay, a triple bottom is the exact reverse with this exact opposite calculations. So a triple bottom is a price pattern which is formed in a downtrend. So again, we see price move up to the resistance, fall back down to the support line, bounce back to the resistance, falls back, bounces back up, falls back down, and then when it breaks that resistance line, it's now told you it was moving in an uptrend. The uptrend ended and moved to a downtrend. We're now in a downtrend. Price is moving down in the downtrend. It hits the lowest it's going in that downtrend, can't get any lower, bounces off there, and that could just be a peak and a valley, a hem and a haw. But then it comes back down to that bottom again, can't get through that bottom. There's not enough sellers to keep driving that price down. So it moves back up to its resistance line. There's not enough buyers to make it move above. It falls back down to the support line. Right now, we're not getting buyers jumping in the market or sellers jumping in the market. Okay. Then it moves back up to that resistance line. And then what happens, we have a surge of sellers that push it higher. So that gives us a buy signal. We can also combine that with volume because we should see a peak in volume at that point. Okay. And that tells us this downtrend is over and we have the momentum to drive price at least to that target level. Okay. Could have traded all the way there, but again, you have to have an estimated target level. So if you have buy here, how much profit could you make, or what will that instant momentum carry it to? Now, again, none of these patterns work individually. You need to use these with other indicators. And as I teach you in all classes, no single indicator tells you anything unless you have other types of indicators to confirm those. Now, the other thing is you have to use these with a grain of salt, a bit of intelligence, because even though we're going to look for the breakout, the quality of the pattern is very important. If the pattern forms in a beautiful, strong uptrend, you're going to probably get the exact results you want. But a lot of times you have a weak trend. You have this messy trend all over the place, and this pattern forms. Well, the messier the trend is, the less defined it is, the less information you get, and the less reliability it is. Okay. But remember, price can break up or break out. Okay, it either crosses above or below. If a breakout, okay, so if the pattern broke out in the same direction as a preceding trend, it's called a continuation pattern because the trend is going to continue. If the breakout is in the opposite direction, it's called a reversal pattern. For example, a pattern described as a bullish reversal triangle would mean that it's a bullish signal, that is, the breakout was through the resistance line upward. Because it's a reversal pattern, that means the preceding trend was in the opposite direction of the breakout. That is, the preceding trend was bearish. So basically, if it breaks above, it's a breakout, and you have strong and weak. And these can be judged depending on how big the buyers or sellers push in that direction when it breaks. Now, all of these have simple calculations to figure the entry point where you put your stop loss and the target point. Okay, but again, they're only guides. You need to have other pieces of information that help you make these decisions. And what you need to do is come to our class on retracements and reversals, and we'll start to show you how you can use these patterns to actually see retracements and reversals, and how we can combine these with Fibonacci retracements or Gann fans to show us more conclusively what we see. You might also want to use them with Elliott wave patterns. Okay. Or MACD works extremely well when you have a chart pattern. But first you have to learn to recognize these patterns. And that's the time-consuming part. Recognizing them, seeing how they form in good, strong trends, seeing how they form in weak trends, and recognizing and just putting them in the pieces of your mind so that when you see this pattern form, you understand that the chart is trying to tell you something. Okay. So on that note, I'm going to say good night to everybody. Thank you very much for coming. This Sunday, there's no class because we have the long holiday weekend. And then we have a whole bunch of new classes coming in September and October. We had some new classes this month, and I think they just posted the calendar for next month. So you can go on ETX and see the calendar right there. Thank you very much for joining us, and have a great week. Thanks for being part of the ETX family. Good night now.